Good morning, students. Welcome you all on the third lecture of financial reporting organized by Board of Studies of ICAI. So students, in the last two classes, we have discussed what are Ind AS. So there are total 39 Ind AS which are notified as on date, and these Ind AS are notified by Ministry of Corporate Affairs. And we have also discussed what is the roadmap for implementation of Ind AS, on which set of companies Ind AS will be applicable. And there we have discussed that Ind AS is only applicable to corporates, only applicable to companies. It is not applicable to banking company and insurance company because Reserve Bank of India and Insurance Regulatory Development Authority has deferred the implementation of Ind AS on these companies. Okay. So friends, then we have discussed some exceptions like NBFC companies, which is not a listed NBFC or having a net worth of less than 250 crores. They are not allowed to adopt Ind AS even voluntarily. Okay. Otherwise, on NBFC companies and companies, Ind AS are applicable. Ind AS are applicable to electricity company. Ind AS are applicable to Section 8 company if these are meeting the net worth criteria of 250 crores or if these are the listed companies, right? Or if Ind AS is applicable to any one company, then it will be applicable to its holding, its subsidiary, joint venture, and associate companies. Friends, while preparing the financial statement under Ind AS, Indian Accounting Standards, you need to refer Division 2 to Schedule 3 for companies other than NBFC, right? And as far as your curriculum is concerned, Division 2 to Schedule 3 is important for you. It is relevant for you, right? So the format is given under Division 2 to Schedule 3, right? But Division 2 to Schedule 3 is not only a recommendatory or not only a sufficient reference for preparation of financial statement. There is Ind AS 1 also which talks about the presentation of financial statement. It means whenever you are preparing financial statement, you have to refer Division 2 to Schedule 3 for the format as well as Ind AS 1 for the presentation of financial statement, right? So let's start the journey of Ind AS 1 and today we will conclude Ind AS 1. In the last class, we have discussed a lot of things about Ind AS 1, right? And we have discussed the component part. So friends, as I told you, whenever you have decided or whenever Ind AS is applicable, Ind AS is applicable to you, in that case, you have to refer Ind AS 1 as well. So coming to Ind AS 1, Ind AS 1 talks about presentation of financial statement. And as far as financial statements are concerned, so Ind AS 1 is talking about what are the key features of the financial statement. What are the key features of the financial statement as well? Key features of the financial statement, okay? I hope my voice is clear to everyone, guys. I hope my voice is clear to everyone. Ishan, Prerna, okay, Rohit, Rohan, okay, good. Yeah. So friends, Ind AS 1 is talking about general features, overall consideration of the financial statement, that how your financial statement should be built, right? What should be the general features? So Ind AS 1 is talking about that. For example, it talks about that financial statement should reflect true and fair view. How this will be reflecting true and fair view, we are going to discuss that, right? But it is saying that financial statement should reflect true and fair view. Financial statement has to be prepared on a going concern basis. It has to be prepared on a accrual basis. So we'll discuss all these aspects, right? So this standard is talking about your general features as well as this standard is talking about what is the purpose of the financial statement. The purpose of the financial statement is to provide the financial position, financial performance, and the position of cash flow to the entity, right? So friends, apart from features, we are going to discuss about components, right? First, we will talk about the features, then we will talk about the component. Key features. Then component. When we are talking about the component of the financial statement, in the last class we have discussed there is a balance sheet, there is a statement of profit and loss, including other comprehensive income, which we are going to discuss. The third statement is statement of changes in equity. The fourth one is notes to accounts and other explanatory information, right? And of course, there is a statement of cash flows as well, right? So we will be discussing about the component of the financial statement, and we have also discussed the concept of the third balance sheet. In case of a correction of an error or a change in an accounting policy, the adjustment is required to be done on a retrospective manner. And while doing the adjustment in retrospective manner, we have to give the third balance sheet. What is the third balance sheet? You have to give the current year balance sheet, previous year balance sheet, and opening of the comparative year balance sheet. For example, if the current year is 21-22, FY 21-22, your balance sheet will be 31st March 22. Your comparative will be FY 2020-21. Your balance sheet will be 31st March 21. Your opening of the comparative period will be 1st April 2020. Okay. Your opening of the comparative period will be 1st April 2020. Okay. So this third balance sheet needs to be prepared whenever there is a change in accounting policy or there is a correction of an error, right? So if you are required to be applied retrospectively, then this third balance sheet will be applicable. If something which has happened in the last year only, then third balance sheet will not be applicable. Okay. Is it clear? Okay. So let's discuss general features or overall consideration. So this standard talks about that your financial statement should reflect true and fair view and in compliance with all Indian accounting standards. The financial statement should present true and fair view. Okay. So how this true and fair view will be achieved? True and fair view will be assumed through application of Ind AS. Sir, how do we, for example, we are a shareholder of a company, we are not a chartered accountant. So how can we say that these financial statements are reflecting true and fair view? If the company has applied all relevant, all applicable Indian accounting standard, then this standard says that it is assumed, it is a rebuttable presumption that financial statements are reflecting true and fair view, right? Sir, how can we aware that the company has complied with all Ind AS? So this is such a meticulous Ind AS. It says that the management has to provide the explicit and unreserved statement of compliance of all Ind AS needs to be disclosed. The management has to give explicit and unreserved statement of compliance. What is meant by explicit? Explicit means clear cut. Explicit means clear. There is no ambiguity. Clear. Okay. And unreserved means no reservation should be there. Management cannot say that we have complied with all Ind AS except, okay. Whenever management is saying except, it means management is putting a reservation. There should be no exception. Management must say the financial statement have been prepared in compliance with all relevant, all applicable Indian accounting standards applicable to the companies notified under section 133 of Companies Act 2013. Okay. Yeah. Departure from compliance of Ind AS. Sir, we understood that in Ind AS financial statement, management has to give a disclosure. And what is that disclosure? The disclosure is management has to give a statement of compliance. It's statement of compliance. What is that statement of compliance? Explicit and unreserved statement of compliance of all Indian accounting standards, right? Whether departure from compliance of Ind AS is possible in extremely rare circumstances where compliance with a standard would be misleading. So it would conflict with the objective set out in the framework. What is that framework? Conceptual framework for financial reporting. This is a document which is prepared by ICAI, and this document, on the basis of this document, the Indian accounting standard are going to be drafted. Okay. So friends, for example, the related party disclosure standard says that the transaction with all the KMPs needs to be disclosed. And for example, there is a bank. I'm just taking an example. Or let's say there is an NBFC company. The NBFC company has given a loan to its CFO in the position of a customer. Okay, in the position of a customer. It means they have taken a same rate of interest which they are charging to the other customers, right? So Reserve Bank of India Act is talking about the confidentiality, right? You cannot disclose the transaction with the customer in the capacity of the customer being just due to the confidentiality, right? So in this case, the departure from the requirement of disclosure of related party in the position of a customer can be done, right? Why? Because of course it will be a requirement, it will be breaching a confidential requirement given in the regulatory framework as well. So guys, departure is permissible if regulatory framework requires or does not prohibit. But whenever you are departing with that, you are required to provide a specific disclosure. For example, you need to write that there is a loan given to a KMP, but it has not been disclosed separately as required by Ind AS 24 due to the confidentiality requirement. Okay. So this is the requirement of true and fair view. How this true and fair view will be achieved? True and fair view will be achieved by way of compliance with all Ind AS and by way of giving a note in the notes to accounts that management has complied with all Ind AS. Friends, if management has given such a disclosure in the notes to accounts for all Indian accounting standards, right? And auditors and an auditor will say that you have not complied with one of the paragraph of Ind AS, right? Or auditor is not agreeing with the treatment done by the management. Whether in that case, can it be assumed that the financial statement are Ind AS compliant? Can it be assumed that the financial statement are Ind AS compliant? Yes, because financial statement are the responsibility of the management. Guys, financial statement are the responsibility of the management. And if management has given, if the management has given an explicit and unreserved statement of compliance with all Ind AS, then it will be assumed that the financial statement are reflecting true and fair view. Okay. And management must have reason to believe that yes, they have complied with the right treatment of Indian accounting standard. They have complied with all Ind AS. Students, I hope everything is clear so far. Going concern. So friends, this is one of the fundamental accounting assumption, and this is one of the key feature given in this standard. It says that financial statement has to be prepared on a going concern basis. On a going concern basis. What is meant by going concern basis? Going concern basis means business will run forever. Right. Sir, run forever means what? Whether it will run forever since infinity? How can we predict that? That what will happen after 20 years, after 15 years? So standard and framework says that the management must have a fair idea about a foreseeable future. What is meant by foreseeable future? What is meant by foreseeable future? What is meant by a foreseeable future? Foreseeable future means 12 months from the reporting date, right? So while preparing, first of all, the financial statement has to be prepared on a going concern basis. It is a fundamental accounting assumption. But if there is an impact in the going concern, then some set of disclosures are required. So when preparing financial statement, management shall make an assessment of an entity's ability to continue as a going concern, right? So how the management will make an assessment that the entity will able to continue as a going concern? The management has to estimate, assess the ability to continue as a going concern in foreseeable future. Foreseeable future. What is the definition of foreseeable future? The definition of foreseeable future is 12 months from the reporting date. It is 12 months from the reporting date. Please write down 12 months from the reporting date. 12 months from the reporting date. So management must estimate that yes, my business will run at least for 12 months from the reporting date. Okay. So an entity shall prepare financial statement on a going concern basis, right? Unless. So when it is not going to be prepared on a going concern basis, when there is intention to liquidate, entity wants to liquidate the business. If entity itself wants to liquidate the business, of course, then then the financial statement will not be prepared on a going concern basis. Or the entity wants to cease the trading. Even in that case, the financial statement will not be prepared on a going concern basis, or no other alternative except to do so. The entity does not have any alternative except to shut down the business. For example, the entity is running into a single geography. For example, there was a liquor company in Bihar. Okay. And that liquor company was a profitable company, cash rich company, sound company. Okay. And that liquor company has only operations in Bihar. So Bihar government has announced that in the next 6 months, the liquor business has to be shut down in Bihar. They cannot trade into a liquor into Bihar. They cannot manufacture liquor in the state of Bihar. Okay. So in this case, friends, when government has announced this kind of decision, whether the entity wants to liquidate the business, answer is no. Whether the entity wants to cease trading, answer is no. But the entity does not have any other alternative except to shut down the business, because the entity has only operations in the state of Bihar. So in this case, the financial statement are not required to be prepared on a going concern basis. It has to be prepared on some other basis like realizable basis, liquidation basis, right? So if financial statement are not prepared on a going concern basis, then you are required to disclose fact, basis, and reason for that, right? And reason for that. In case of any material uncertainty, for example, in case of COVID, right? So many business were impacted in case of COVID. Have you heard about Oyo? Have you heard about Oyo? Oyo rooms? Yeah. Have you heard about Oyo, guys? Oyo rooms? So guys, in case of tour and travel industry, in case of hotel industry, hospitality industry, in the COVID time, all these industries were impacted. No one is using these hotels, right? No one was traveling. So guys, their revenue was drastically dropped, right? So whether these companies like Oyo, like Indigo Airlines, right? These tour and travel companies, Make My Trip, whether these companies have not prepared their accounts on going concern basis? No, they have prepared their accounts on going concern basis, right? But if in case of any material uncertainty is there, the disclosure is required. So these companies have given the disclosure, right? For example, if this COVID will linger on for 5 years, 6 years, 7 years, then what will happen? Then probably these businesses will get shut down, right? Because they have some cost attached to that, right? So friends, in case of any material uncertainty, if there is any doubt, any challenges, so those material uncertainty is required to be disclosed even though the accounts are prepared on a going concern basis. Okay. Sir, what could be the trigger when management can say that there is an impact on the going concern? For example, negative net worth. This is an indicator of a impact of going concern. I'm not saying that the going concern will be impacted. This is an indicator. Your working capital ratio become negative, right? Your working capital deficit, negative net worth, recurring losses. So creditor has withdrawn the credit support. Earlier creditor was saying that I will give you 2 months credit. Now creditor does not want to give us credit. Lender has seized our credit limits. Bank. Earlier bank was given us a CC limit of 2 crore rupees. Now bank has seized our credit limits, right? So bank is not willing to give loans. The company does not have sufficient funds to meet the expenses, right? So friends, these are the indicator of material uncertainty, or these are the indicator there could be an impact on a going concern, right? Let's discuss a case study on going concern. An entity is engaged in a plastic product manufacturing in a particular area. The entity is a very profitable entity and has huge order in hand as on 31st March 2020. Sound company, cash rich company. The government has announced on 31st March 20 to ban trading and manufacturing of plastic after 30th September 2020. So on the reporting date, government has announced a decision that you guys will not be able to manufacture and trade plastic after 30th September. And this is the only product in which the company is engaged. Advise the company on going concern aspect as per Ind AS 1. So friends, in this case, whether company will prepare its accounts on a going concern basis or on some other basis. So first of all, you tell me please, in this case, whether the company wants to liquidate the business? Answer is no. In this case, whether the company wants to cease the trading? Answer is no. But in this case, the company does not have any other alternative except to shut down the business, right? Except to shut down the business. So in this case, the company will not prepare its account on a going concern basis. Why? Because 6 months from the reporting date, after 6 months from the reporting date, the business will get shut down. Okay. In this case, although neither the company has ceased trading nor management intends to liquidate the entity, but there is no alternative except to do so due to government announcement within 12 months from the reporting period. Hence, there is an impact on a going concern basis. I hope it is clear. Yeah. So, friends, third key feature will be accrual basis. What is meant by accrual basis? Financial statement needs to be prepared on an accrual basis. Financial statement needs to be prepared on an accrual basis, except cash flow statement. Okay, except cash flow statement. Financial statement needs to be prepared on accrual basis, except cash flow statement, because its cash flow statement is like a cash account, right? So what is meant by accrual basis? So transactions and events are recognized when they occur and in the period to which they relate. For example, on 1st February, 2022, the company has paid an insurance premium of 12,000 rupees, right? And the insurance premium is for a period of 12 months. So in this case, friends, it is for a period of 12 months. In this case, the company, although the company has paid 12,000 in the financial year 21-22, but 11-month expenses is relating to 22-23, 1 month expenses is relating to 21-22. Okay. So in this case, 11,000 will be transferred to prepaid expenses and 1,000 will be recorded in the current year, right? So the expenses is not going to be recognized on a case basis. It has to be recognized on an accrual basis. So 1,000 expenses will be recorded in the current year. Expense account debit 1,000. Prepaid expense asset account debit 11,000. To cash or bank account 12,000, right? So accrual basis we all are aware, right? Is it clear? Manav is saying, sir, if there is no material uncertainty, but COVID has impacted the company disclosure required. So Manav, in COVID case, yes, company has given the disclosure. Where the COVID has not given a material impact, the company has written that there is no material impact of COVID to that company, right? But the companies have given disclosure during the COVID time. Dara, can you elaborate your question? I have not understood your question, sir. When will previous? I have not understood this. So accrual basis, we understood the accrual basis. Now coming to the aggregation and materiality. What is meant by aggregation and materiality? Okay. So aggregation and materiality. So before aggregation and materiality, just discuss consistency. Okay. So what is meant by consistency? As far as presentation is concerned, as far as a period is concerned, right? So as far as accounting policy is concerned, so an entity has to maintain consistent application of accounting policy, consistent presentation in the financial statement on a period to period basis. For example, earlier the management has shown the traveling expenses separately, right? So now in the next year, the management cannot merge the traveling expenses into other expenses, right? So the presentation consistency needs to be maintained, or the application of accounting policy consistency needs to be maintained from one period to another so that the accounts will be comparable. Okay. Now coming to the materiality and aggregation. What is meant by materiality and aggregation? What is meant by material? Material means an item. You remember we have discussed this. An item, if it needs to be, or if this item cannot be disclosed, or this item is misrepresented, or this item is obscured, it will impact the decision making capacity of the user of the financial statement. Okay. So if there are material item, it has to be present separately. It has to be present separately. Okay. Materiality depend on the size of the business. Materiality depend on the nature of the transaction, right? For example, for Reliance Industries, 1 crore could not be material. But for a small company which is having a balance sheet size of 5 crore or 10 crore, 1 crore is a material number. Okay. So guys, materiality depends on a size of the business as well. Yeah. So Kishan is saying, sir, how to deal expenses of previous year in current year if bills raised with GST in current year belongs to last year. How to deal with this provision? So Kishan, first of all, I'll not go into the text part. I'll go into the reporting part, financial accounting and reporting. You are saying that if we have raised the bill in the current year, but the revenue belongs to the last year, right? And since you are raising a bill in the current year and hence you are recognizing a revenue in the current year. So in this case, if the revenue was supposed to be recognized in the last year, it is a clear-cut case of your error, right? As per Indian accounting standard, if it is a material error, then you need to restate your last year accounts. Although you are raising a bill in the current year, but you need to restate your last year accounts. As far as GST provision is concerned, if the GST department believes that this revenue belongs to the last year and somehow the GST has been postponed and deferred, probably they may impose an interest or penalty on that, right? So this is the answer of the question which you have asked. Dhara, the previous lecture's notes has been shared with Board of Studies of ICAI yesterday. Manav is saying if no material uncertainty is there, but COVID impacted the company, then company is required to give disclosure only and prepare financial statement on going concern and accrual basis. Yes, Manav. In that case, only COVID related disclosure is required. No material uncertainty relating to going concern is required. Okay. So Manav, if there is a material uncertainty relating to going concern, in that case, disclosure is required with respect to material uncertainty relating to going concern. Okay. But the COVID related, if there is an impact of COVID, but there is no impact on going concern, there is an immaterial impact of COVID or a very small impact of COVID, then only COVID related disclosure is required. Okay. Is it clear, friends? No worries, Koshiki. I will discuss with or I'll speak with Board of Studies of ICI. Okay. So guys, if there are material item, it has to be presented separately. For example, exchange difference. If there is a huge exchange losses on account of currency fluctuation, in that case, it has to be disclosed separately. Gain and loss on sale of fixed assets. If there is a material gain and loss on sale of fixed asset, it has to be disclosed or presented separately, right? Immaterial item has to be aggregated with other item. For example, printing and stationery expenses, cartage expenses, right? They can be merged with other expenses as well. So if there are small items, immaterial item, it can be aggregated and shown as one item, like other expenses, other asset, other current asset, other current liability. Okay. Offsetting. So friends, how many key features we have discussed so far? We have discussed presentation of true and fair view and compliance with Ind AS. Going concern is one of the key features. Accrual basis, aggregation and materiality. Then we have discussed consistency of presentation, right? Now we are going to discuss offsetting. What is meant by offsetting? Offsetting means setting off assets and liabilities, setting off income and expenses. So guys, if we set off the entire assets and liabilities in the balance sheet, in that case, only reserves and surplus will be left in the balance sheet, right? If we set off revenue and expenses in the balance sheet, in that case, only PAT, profit after tax or PBT will come into the P&L, right? So friends, in case of offsetting, an asset and liability will be offsetted and income and expense will be offsetted only when it is required or permitted by an Indian accounting standard. When it is required or permitted by an Indian accounting standards. Okay. So if Ind AS does not permit, you cannot offset asset, liabilities, income and expenses, right? Sir, can you give some example to that? Yes. For example, when you read Ind AS 115, when you read Ind AS 115. Ind AS 115 is a standard which talks about revenue accounting. Revenue from contract with customers. Revenue from contract with customers. Okay. So friends, when you read this Ind AS 115, it says that if there is a trade discount, if there is a volume discount, if there are discounts which is given to the customer, if there is a discount which is given to the customer, so revenue has to be recognized net of discounts. For example, the revenue is 100 rupees and the discount, for example, the revenue is 100 rupees and the discount is, let's say, 10 rupees. In that case, 90 rupees has to be recorded in case of a revenue. Okay. So this discount is required to be offsetted. Where it has been written? It has been written in Ind AS 115. Second example, Ind AS 37. When you read Ind AS 37, it talks about provisions, contingent liability, and contingent asset. So, for example, you are a dealer of a Samsung. You are a dealer of Samsung mobile phones, right? You are giving a warranty to the customer, and whatever damages or whatever warranty will come, for example, in a year, you will get a warranty expenses of, you have to incur a warranty expenses of 1 lakh rupees, right? Some customer has come and you have to repair the mobile phones. And the cost of that warranty obligation is 1 lakh rupees. And this 1 lakh rupees is going to be reimbursed from the third party, which is manufacturer. Okay. So friends, in this case, Ind AS 37 says that the expenses which have been incurred on account of warranty given to the customer and the reimbursement or income which have been received from the manufacturer in respect to such warranty, this income and expenses, this reimbursement can be netted off in the profit and loss account. But the provision for warranty, which is a liability, and the receivable from the manufacturer, which is an asset, it cannot be offsetted in the balance sheet. Why? Because Ind AS 37 does not allow. Sir, what is the logic why it does not allow? Because you have to get the money from a different party and you have to pay the money to a different party. You have to incur the expenses towards a different party, right? So in the balance sheet, one should be aware that even though the manufacturer will not provide you the warranty, the customer will come to you to get the warranty, right? So in that case, so that is why Ind AS 37 says that in the balance sheet, it cannot be offsetted, but in the P&L, it can be offsetted, right? It can be offsetted. Is it clear? Manav has given a very good example. Very good example. Ind AS 12, it talks about income taxes. It says that deferred tax asset and deferred tax liability can be offsetted if it belongs to a same jurisdiction, right? If it belongs to a same jurisdiction. Good, Manav. Right? So guys, assets, liabilities, income and expenses shall not be offsetted until and unless it is required or permitted by some Indian accounting standards. Sir, if we are creating a provision for bad debt, is it a offsetting? Although you have to net off this provision for bad debt from the receivables in the balance sheet. Is it offsetting? This is not an offsetting. This is an allowance. This is a provision. This is an allowance. Okay. So as per Ind AS 2, measuring assets net of the valuation allowances, for example, obsolescence allowance, provision for doubtful debt, this is not considered as an offsetting. Provision for investment allowance, this is not considered as an offsetting. This is an allowance which you have created considering there could be a loss on your asset. Okay. I hope it is clear to all of you. Yeah. Clear? Clear, friends? So coming to the frequency of the reporting. So as far as frequency of reporting is concerned, the reporting should be consistent from one period to another, and entity is required to report at least for 12 months, right? At least for the 12 months. Yeah. Comparative information. Comparative information has to be given at least for 1 year, and comparative information includes narrative information as well as descriptive information. Narrative as well as descriptive. Okay. Clear? So you have to give the comparative in the balance sheet, P&L, cash flow, statement of changes in equity, as well as in the notes to accounts, you have to give the comparatives. Clear? So guys, we have discussed the key features of the financial statement. Now let's discuss the component of the financial statement and their structure and content. Okay. So coming to the structure and content, your financial statement in an annual report, there are a lot of statement, right? There are a lot of statement in an annual report. For example, board of directors report, corporate governance report, management discussion and analysis report, right? Business responsibility and sustainability report. Then your financial statement. Standard says that in a particular set of framework, your financial statement, or in a particular document, your financial statement should be clearly distinguished from other information. So whenever you open the annual report, you will find that you will be able to understand that yes, this section belongs to the financial statement, right? In annual report, in index, there is a separate section for financial statement, right? Reporting period. So the reporting period is at least annually. You have to explain if longer or shorter, right? If it is a first company, that is the first year of the company, the financial statement could be longer or could be shorter, right? Information required. The standard says that the name of the company has to be given in the financial statement. Okay. And you must have seen in every balance sheet, Reliance Industries Limited balance sheet as at 31st March 22. Okay. Name, and if there is a change in name, it is required. Whether it is an individual financials or group financial, it is required to be disclosed, right? Whether it is standalone financial or consolidated financials. Period covered. What is the period covered? For example, balance sheet as at 31st March 22, statement of P&L for the year ending 31st March 22, right? Is it a 3 months, 6 months, 9 months, 12 months? So period covered has to be disclosed. Currency, whether the financial statement has been presented in INR, in US dollars, it has to be disclosed. Level of rounding, rupees in million, the level of rounding of has to be disclosed. Yeah, is it clear, friends? I hope it is clear to everyone, guys. Any challenge? Let me show you an annual report so that you will be able to understand this. I hope this annual report is visible, guys. You can see that this is a balance sheet as on 31st March 20, and amounts in million of Indian rupees. So level of rounding off is in millions, and currency is INR, right? Currency is INR. And you can see this is an annual report, right? And from here, the section of financial statement have been started. You can see that standalone financial statement, right? In the annual report, it is given that it is a standalone financial statement, and then financial statement have been started, right? I hope it is clear to all of you. Is it clear to all of you? Very good. We are talking about the basic things in terms of Ind AS 1, right? Ind AS 1 is one of the important and very basic standard. Now coming to the structure and content of the financial statement, right? So first let's discuss about the balance sheet. Friends, I have shown you the balance sheet format, right? So how this balance sheet format will look like? The balance sheet format will look like, initially you have to give the balance sheet format started with asset, right? So we have seen in the division 2 to schedule 3. In division 2 to schedule 3, we have seen this thing, right? So the division 2 to schedule 3 talks about the format of the balance sheet, format of the P&L. So you can see that Ind AS balance sheet start with the asset. And in asset, there will be a non-current asset and current asset, right? In non-current assets, property, plant and equipment, right of use asset, CWIP, intangible asset, investment, financial asset, investment, other financial asset, income tax asset, deferred tax asset, other non-current asset. Right? In current assets, under financial asset, there is an investment, trade receivable, cash and cash equivalent, other bank balances, other financial state assets, and there is a other current assets as well, other current assets. Okay. Then there is a equity, equity share capital, other equity, non-current liabilities, current liabilities. Note numbers, the note numbers are also given. In the note, there is a breakup of these assets and liabilities, right? Then there is a current year, then there is a previous year, right? So the format of balance sheet is given in the division 2 to schedule 3. But Ind AS 1 also prescribe the minimum line item to be presented on the face of the balance sheet. So Ind AS 1 says that your balance sheet has to be segregated or bifurcated into current and non-current, right? We discussed in the last class what is meant by current and what is meant by non-current. You remember, I have also mentioned that Ind AS 1 gives a guidance of current and non-current. And we have discussed this guidance in the last class, that the current and non-current depend on the operating cycle, or it will depend on 12 months, right? So division 2 to schedule 3 prohibits the classification based on liquidity. But Ind AS 1 says that you have to classify on the base of liquidity if more relevant. For example, NBFC companies, the financial statement of NBFC company, the balance sheet of NBFC company is into the basis of liquidity. If you see division 3 to schedule 3, that schedule 3, division 3 to schedule 3 gives the format into a financial and non-financial, right? It gives the format on the basis of liquidity. So friends, division 2 to schedule 3 does not allow liquidity, but Ind AS 1 allows liquidity if more relevant. When it will be more relevant, sir? For example, the company is not preparing the accounts on a going concern basis. It is preparing on the account on realizable basis. In that case, the classification on the basis of liquidity is more relevant, right? And in this case, applying Ind AS 1, that entity has to present its financial statement or balance sheet on the basis of liquidity classification, right? Ind AS 1 has given some important line item on the face of the balance sheet, like property, plant and equipment, non-current asset, investment property, intangible asset, financial asset, trade and other receivables, cash and cash equivalent, biological asset, inventories, investment accounted for using the equity method, right? PPE, you have to read this PPE in Ind AS 16. Investment property, Ind AS 40. Intangible asset, Ind AS 38. Financial asset, Ind AS 109. Trade and other receivable, Ind AS 109. Cash and cash equivalent, Ind AS 7. Biological asset, Ind AS 41. Inventories, Ind AS 2. Investment accounted for using the equity method, Ind AS 28. Non-current asset and classified liability is classified as HFS, Ind AS 105. Trade and other payables, Ind AS 109. Provisions, Ind AS 37. Financial liability, Ind AS 109. Liabilities and assets for current tax, Ind AS 12. Deferred tax, Ind AS 12. Non-controlling interest within equity, Ind AS 110. Issued capital and reserves attributable to the equity holder of the parent. So this is Ind AS 1. Okay. Ind AS 1, I mean to say this is just a capital and equity, right? So friends, Ind AS 1 para 54 also gives you that you have to present these line item on the face of the balance sheet, on the face of the balance sheet. So you have to refer division 2 to schedule 3 and you have to refer Ind AS 1 for the preparation of balance sheet. Students, I hope things are clear so far. Any challenge, any doubt, please let me know. I hope everything is clear so far. Yeah. Clear. So as per Ind AS 1, which one of the following item is not required to be shown on the face of the balance sheet? Biological asset, property, plant and equipment, investment property, contingent liability, intangible asset. Intangible asset. Tell me which is the right answer. Tell me, friends, what is the right answer? Great. Contingent liability, it is an off balance sheet item. It is an off balance sheet item. Okay. So current asset, non-current asset we have discussed in the last class. What is meant by current asset? When an entity expects to realize the asset or intends to sell or consume it in its normal operating cycle, it is considered as a current asset. It is considered as a current asset. Or it expects to realize the asset within 12 months. It is considered as a current asset. Or it holds the asset primarily for the purpose of trading. Primarily for the purpose of trading. Like the company is purchasing mutual funds, shares for the purpose of trading. It will be considered as a current asset. Or the asset is a cash or cash equivalent, right? Cash or cash equivalent. So cash or cash equivalent is defined under Ind AS 7. What is meant by cash equivalent? Cash equivalent means any item which can be realized in a known amount of cash. Cash or cash equivalent means an asset or an item which can be realized in a known amount of cash within a short-term period of 3 months. And there will be a insignificant risk of change in value. Sir, for example, a company has purchased shares, Infosys shares, right? Can this investment in Infosys shares, although Infosys is a listed company, so for example, you have purchased the shares on Friday, even you can sell these shares on Monday, right? After 2 days. So can I show this purchase of shares as a cash and cash equivalent? Answer is no. Why? Because the definition of cash and cash equivalent is an item which can be readily converted into a known amount of cash, into a known amount of cash, into a known amount of cash. I'm aware that how much money I'm going to realize, okay, into a known amount of cash. And there is an insignificant risk of change in value. So guys, in case of purchase of shares, can I say there is an insignificant risk of change in value? There is a high risk of change in value. For example, Monday, if the market will go down, if there will be economic crisis, if there will be a negative news of the company, so probably the share will drop downward. Okay, the share will go downward. Okay, so we are not aware how much money we are going to realize on Monday, right? So hence, in such kind of investment, although it is a highly liquid investment, short-term investment, but it cannot be converted into a known amount of cash, and there is a significant risk of change in value, and hence purchase of investment is not a cash and cash equivalent. I hope it is clear to all of you. Yeah. So asset which is not current is considered as a non-current asset. What is current liability? Same, settled in the normal course of the operating cycle or due to be settled within 12 months of the balance sheet date. Held primarily for the purpose of being traded. For example, some liabilities has been taken for the trading basis, right? For example, we have some debentures and the debenture is for the trading basis, right? So it is considered as a current liability. Or there is no unconditional right to defer settlement for at least 12 months. If the counterparty will come and ask for the money or ask for the settlement, the company will not be able to defer the settlement after a period of 12 months, right? There is no unconditional right. There is no contractual right. In this case, this will be considered as a current liability. So likewise, liability which is not current is considered as a non-current. Okay, it is not considered as a non-current. Inventory or trade receivable of Pluto Limited are normally realized in 15 months. Should Pluto Limited classify such inventory or trade receivable as current? Tell me, guys. Yes or no? Yes or no? Yes. Why? Because 15 months is an operating cycle, right? If operating cycle cannot be determined, then 12 months has to be taken. So let's discuss some examples of current and non-current classification. Then we will discuss the next part. Okay. Let me know if the institute study material is visible, guys. Let me know if it is visible. I hope it is visible now. Yeah. friends, let's discuss example number 8. Okay. An entity produces whiskey from barley. So there is a barley, wheat, okay, and the entity is producing whiskey, water and yeast in 24-month distillation process. So the processing of whiskey is a 24-month distillation process. At the end of the reporting period, the entity has 1 month supply of barley and yeast raw materials, right? At the end of the reporting period, the entity has 1 month supply of barley and yeast raw material, 800 barrels of partly distilled whiskey and 200 barrels of distilled whiskey. Okay. So the company has raw material in a short story. The process is 24 months and the company has some raw material, some work in progress and some finished goods, right? All raw material, barley, work in progress, partly distilled and finished goods, distilled whiskey are inventories. These are inventories. The raw material are expected to be realized, that is turned into a cash after being processed into whiskey in the entity's normal operating cycle. Therefore, even though the realization is expected to take place more than 12 months after the end of the reporting period, the raw material, WIP and finished goods are considered as a current assets, right? Why? Because the operating cycle is 24 months. Clear? Is it clear, friends? Clear? Okay. Let's move on. An entity owns a machine with which it manufactures goods for sale. It also owns the building in which it carries out its commercial activities. Tell me, such building or machine, is it a current asset or non-current asset? Whether this building or machine, tell me whether this building or machine is a cash or cash equivalent. Answer is no. They are not a cash or cash equivalent. Whether they are expected to be realized or consumed in the entity's normal operating cycle or 12 months. Answer is no. It is not going to be consumed in the normal operating cycle or in the 12 months, right? Whether this building or machine is held for the purpose of trading. Answer is no. And hence, it is not meeting any of the condition and hence it is a non-current asset. It is not a current asset. It is a non-current asset. I hope it is clear to all of you. Yeah? Clear? Good. Yeah. Let's go to the next part. On 31st December 2002, an entity replaced a machine. An entity replaced a machine for rupees 3 lakh. Payment is due 15 months after the end of the reporting period. After the end of the reporting period. So guys, so this is one of situation, right? This sale of machine is not a ordinary course of business of this entity. This is not a bread and butter of this entity, right? So in this case, the operating cycle is not given. We will consider 12 months, right? So the payment will be due after 12 months from the reporting date. So tell me whether this will be a current asset or will be a non-current asset. So again, we will see the 4 conditions. Whether this money received from customer is a cash or cash equivalent. Answer is no, it is not a cash or cash equivalent. Whether it is expected to be realized or consumed in the entity's normal operating cycle. Operating cycle is not given in this question. Whether it is expected to be realized within 12 months. Answer is no, because 15 months due date is there. Whether it is held for the purpose of trading. Answer is no, right? So hence, this receivable is considered as a non-current asset, right? But if in the question it is written that the payment is due in, let's say, 9 months, then since it is less than 12 months, so it will be classified as a current asset. Okay, it will be classified as a current asset. Clear? Next question. On 1st April 2002, on 1st April 2002, XYZ Limited invested rupees 15 lakh surplus funds in corporate bonds that bear interest at 8% per year. So they have invested 15 lakh rupees in a corporate bonds, and that bond will give you an interest of 8% per year. Interest is payable on the corporate bonds on 1st April of each year. The principal is repayable in 3 annual installments of rupees 5 lakh starting from 1st April 2003. So friends, the company will receive interest every year, okay, on 1st April of each year. So on 31st March, you will prepare the financial statement and next day you will get the interest, okay. It will received every year. And you will get the principal repayment in 3 equal annual installment of rupees 5 lakhs starting from 1st April 2003. You have invested in 1st April 2002. When you prepare the first financial statement on 31st March 2003, you will get the first interest and first refund of principal of rupees 5 lakh on 1st April 2003. So friends, in this case, tell me what is current and what is non-current. Tell me. So friends, first of all, the accrued interest. So as on 31st March 2003, in the balance sheet, because the interest has to be received in the next day only, which is within 12 months from the reporting date. So 15 lakh multiplied by 8%, 1,20,000 of accrued interest has to be shown as a current asset, accrued interest or interest receivable. And next day you are also getting a principal repayment of rupees 5 lakh, which is a current portion of the non-current investment. It is not non-current loan, it is non-current investment, right? Because we have invested, right? So the 5 lakh rupees is again a current portion of a non-current investment, and 10 lakh rupees has to be shown as a non-current asset on 31st March 2003. I hope it is clear to everyone. Why? Because the 10 lakh rupees has to be received 5 lakh on 1st April 2004 and 5 lakh on 1st April 2005. So it is beyond 12 months from the reporting date, which is 31st March 2003. I hope it is clear to all of you guys. Is it clear? Yeah. Okay. Yeah. Let's move forward. So guys, in this case, illustration number 5, you have to compute the operating cycle. X Limited provide you the following. What is operating cycle? It is cash to cash, right? Raw material holding period 3 months, WIP 1 month, finished goods 5 months, data collection period 5 months. So the moment you have invested in raw material, it took 3 months, right? Raw material holding period is 3 months. Then your WIP 1 month, 5 month finished goods, 5 month data collection period. What is operating cycle? 3 plus 1 plus 5 plus 5. So 4 plus 5, 9 plus 5, 14. 14 month is your operating cycle. 14 month is your operating cycle. Inventory or trade receivable of X Limited we have discussed, right? So we have discussed this. B Limited produces aircrafts. The length of time between first purchasing raw material to make the aircraft and the date the company complete the production and delivery is 9 months. So the length of the time between first purchasing raw material and completing the production is 9 months and delivery is 9 months. The company received payment for the aircraft 7 months after the delivery. So till the time of delivery, it took 9 months and the collection period is 7 months. So 9 plus 7, 16. What is the length of the operating cycle? The length of the operating cycle is how much? It is 16 months. How should it treat its inventory and debtors? Tell me, how should it treat inventory and debtors? So the debtor, when they will recognize debtor, it is 7 months, right? And the inventory holding period is roughly 9 months. So how should it treat inventory and debtors? Guys, of course, if the operating cycle is 16 months and it is within 16 months, the inventory and debtor is within 16 months. So of course, it has to be classified as a current liability, as a current asset, right? As a current asset. I hope it is clear to all of you. I hope it is clear to all of you, friends. We have also discussed some case study from Institute study material. So now let's once again discuss carve out in respect of long-term loans, right? So what is that carve out? You remember we have discussed some carve out. You remember? If you are not remembering, then let me show you Excel file. In the first class, you must have remembered that I have discussed carve out, carve-ins and removal of option. And what we have discussed, carve out means applying different treatment in Ind AS. So in IFRS, for example, reporting date is 31st March 22. I'm just revising, okay? The company has taken a long-term loan on 15 November 2021 for a period of 5 years. And reporting date is 31st March 22. And this loan is repaid after a period of 5 years. So guys, on 31st March 22, what is the classification? In IFRS, IAS 1 says that the classification is non-current. Okay, where even in Ind AS, the classification is non-current. But on the reporting date, the company has made a violation of loan covenants, loan condition. And due to this, the loan become repayable on demand, right? In IFRS, the classification will change to current. In Ind AS, on the reporting date, the classification will change to current. Okay, right? There is no problem. So in the first instance, even in Ind AS, here in Ind AS, the classification will be non-current. In IFRS, the classification will be non-current. When the default happened, the classification have been changed to current. Now some other information is also given. The financials are going to be approved or adopted in the board meeting scheduled on 15 May 22. In the month of April, that is between the reporting date and approval date of the financial statement, the management talked with the bank and bank agreed to waive the violation and will not demand the payment immediately and will go by the old payment terms, right? So friends, in IFRS, IAS 1 and IAS 10 says that it is a non-adjusting event. So you are required to continue to show this loan as a current loan and you have to give the proper disclosure in the notes to account. But under Ind AS, friends, Ind AS says that after reporting date, but before approval of the financial statement, things become normal now, right? So there is no point of changing the classification from non-current to current. And hence, under Indian accounting standard, we have considered this thing as a adjusting events, right? And hence, in Ind AS, this has to be shown as a non-current loan, right? This has to be shown as a non-current loan. Is it clear? Srishti is saying, sir, in example number 8 operating cycle. Yes, Srishti, in example number 8 operating cycle should be 25 months. You are right. Because 1 month, your supply or delivery time is also required to be considered. You are right. Clear, friends? If you have seen the lecture 1, lecture 1 of the first class of the first session, then you must have remember, or you will be able to recall this carve out. And I have just given stepwise detail, right? Okay, let's quickly discuss a case study on this carve out. Release Rooster Inc. There are just a fancy name in IFRS. These kind of names are there. This is a company, and this company has a December 31st year end. Okay. As of 30th June 2019, RRI obtains a $1 lakh loan from a bank for a new chicken coop facility. As of 30th June 2019, this company has taken a loan from a bank for a new chicken coop facility, right? The loan is due in 24 months. So this bank has taken a term loan for a particular purpose, and this loan is due in 2 years. In December 2019, that is after 6 months, RRI spends too much of its cash on its holiday party and incurs a debt covenant violation as of 31st 2019. The bank has given a loan for the business purposes, but the company has spent on a party, right? So it means there is a loan term violation. There is a condition violation of a particular loan. As a result of the violation, the loan become due within 30 days. The loan become due within 30 days. Okay. At this time, RRI asked the bank to waive the violation, and the company discussed with the bank that please waive the violation. Why? Because instead of 18 months, the loan become due immediately, right? Within 30 days. RRI also says the bank that it will recoup some of its cash by selling its party residuals. RRI, the company says that we have left some grocery or left some items or decorative items from the party, and we will sell those things, and we will recoup some of the cash. Okay, so everything has not been spent. Some cash we will be able to realize by selling the residuals. Okay, so on 5 January 2020, that is after 5 days, the bank agrees to waive the violation. Okay, and the financial statement are approved on in the board meeting dated January 25, 2020. So friends, in IFRS, tell me how should this loan be classified, current or non-current, in RRI's balance sheet as on 31st December 19 under IFRS and Ind AS. Tell me, under IFRS and Ind AS, whether this liability or loan will be non-current or current. What will be the classification? Soham is saying non-current in IFRS and current in Ind AS. Soham, you are telling just reverse, right? In IFRS, since it will not be considered as an adjusting event, it will be considered as a non-adjusting event. In IFRS, it will be current. In Ind AS, since the original classification was non-current and the bank has also agreed not to demand the payment, so in Ind AS, it will be continued as a non-current. Why? It will be considered as an adjusting event, right? Is it clear? Yes, Girish, you are right. Srishti, you are right. Srishti, you are saying both Ind AS and IFRS, it will be current. It is wrong, Srishti. In IFRS, it will be current, but in Ind AS, it will be non-current because the bank has agreed to waive the violation, right? Before approval of the financial statement, the bank has agreed to waive the violation. Is it clear? Srishti, are you clear on this? Yeah. Okay. So friends, let's move to the next concept of statement of profit and loss. Friends, I think, friends, I believe you guys are clear on the balance sheet. So in Ind AS 1, some line items have been given on the face of the balance sheet, and you have to refer those line items as well while preparing the balance sheet. Okay. These are the line items which I have shown you, right? And Ind AS 1 prescribed that the entire balance sheet line item has to be classified into, current and non-current, right? The liquidity presentation can be applied if it is more relevant, right? This is given by Ind AS 1, and the current and non-current guidance is also given by Ind AS 1, right? So this carve out is also given in Ind AS 1. So we have discussed these aspects. Let's move to the next component, which is statement of profit and loss, right? And I will explain this entire concept of statement of profit and loss with the help of Excel file, right? And before that, let me show you the practical aspect of it. Then I'll move to the Excel file. Okay. I hope it is okay to everyone. Please let me know if my screen is visible. I mean to say, if this annual report is visible, guys. Statement of profit and loss for the year ended. Okay. So this is particulars. This is not referencing current year, and this is the last year, right? In balance sheet, the word is asset. In P&L, the word is year ended. Okay. If you see the statement of profit and loss, income is there, revenue from operation, other income, total income. Some expenses are there, right? And after expenses, you can see the profit before tax is there. income tax expense is there, profit after tax is there, which is known as a profit for the year. And then there is a section of other comprehensive income. Right. In other comprehensive income, there are two line items. Item that will not be reclassified to P&L, item that will be reclassified to P&L. Okay. And the profit, which is A, plus the total plus other comprehensive income, which is B, the profit for the year and other comprehensive income. So PAT plus OCI, other comprehensive income, is known as TCI, total comprehensive income. So you can see total comprehensive income or loss for the year. Then there is a earnings per share. Okay. So this is the format which the listed companies are using, right? And where this format is given under Division 2 to Schedule 3. This format is given, right? So friends, let's discuss the concept of statement of profit and loss in Ind AS 1. Okay. The format is given under Division 2 to Schedule 3, but Ind AS 1 also gives the structure and content of the component of the financial statement. Ind AS 1 para 83 to 86 says that what could be the line item on the face of the statement of P&L, like revenue from operations, other income, employee benefit expenses, finance cost, right? Your depreciation and amortization, tax expense, right? Profit or loss from discontinuing operation, share of investment in joint venture or associate, right? So these line item has also been given in the Ind AS 1 statement of P&L format, right? Statement of P&L. But as far as the format is concerned, you have to refer Division 2 to Schedule 3. Okay. So friends, in statement of P&L, I have drafted one statement of P&L so that you will be able to understand properly. Because being a CA final students, you guys must have seen the financial statement so far, or you guys must have prepared the financial statement in your articleship period, or you guys must have audited the financial statement in your articleship period, right? So friends, I have just given the name of this P&L as a part 1 and part 2. I have bifurcated this P&L into part 1 and part 2. Let's discuss the part 1. Revenue in the income side, revenue from operation, other income, total income, right? Same format which we have seen earlier. For example, revenue is 1000, to other income is 200, total income is 1200. Employee benefit expenses, other expenses, impairment, depreciation, finance cost, right? So this is amount which I have written. The total expense is 450. Profit before tax and other items, it is 750. Very simple format, which we have learned earlier also, which we are already aware. Then there are three kind of items in the P&L: extraordinary item, exceptional item, and prior period item. Guys, in your accounting standard P&L, in your old IGAAP P&L, you guys were showing prior period items separately as a face of the P&L. Tell me whether under Ind AS 1, do we require to show this prior period item as a separate line item on the face of the financials? Yes or no? Yes or no? If there is some error, do we need to show those errors as a prior period item in the current year, or we have to do some different treatment? You remember I have shown you ONGC financials also. This is saying no only extraordinary item. This I'm not coming on extraordinary item. I am discussing only prior period item. So guys, you are right. So Rohan has replied, Radhika has replied, Manav has replied, Kushiki has replied. You are right. Prior period item is not a concept in Ind AS or IFRS. It is not a concept of Ind AS or IFRS. If it is a material prior period error, then your comparative number needs to be restated. Third balance sheet needs to be given and comparative P&L needs to be restated. If the error is not material, then it is not considered as an error itself. So whatever you have left, you just have to give a treatment in the current year in the respective line item. For example, the salary expenses. The accountant has forgot to record salary expenses in the last year. Don't worry. If it is immaterial, book that salary expenses as a current year salary expense, right? So the concept of prior period expenses was there in the old IGAP was there in division 1 to the schedule 3, but it is not given in division 2 to schedule 3. It is not given in Ind AS 1. So prior period concept is not there. Right? Why? Because of the restatement concept. Then coming to the extraordinary item and exceptional item. So friends, in our accounting standard 5, the concept of extraordinary item or the concept of exceptional item, both were there. What is meant by extraordinary item and what is meant by exceptional item? Extraordinary item, extraordinary items are those items which are not in the ordinary activity of the entity. For example, what could be the example? Loss of inventory due to fire, right? Robbery of cash, embezzlement of cash, right? These are the example of extraordinary activity. You cannot say na ki yes, loss of inventory due to fire is an ordinary course of activity, is an ordinary course of business. You cannot say कि हाँ ये तो होता ही रहता है. Yes, it is ordinary. This is not ordinary. So extraordinary item are those items which are not in the ordinary activity of the entity. What is meant by exceptional item? I'm talking about the accounting standard definition, AS definition. Exceptional items are those items which are ordinary in the which are ordinary activity, which are in the nature of ordinary activity of the company, of the entity, but require separate disclosure as exceptional due to the size and nature. For example, provision for bad debt, right? If the company is selling a goods on credit basis, of course, provision for bad debt will be there, right? So it is in the ordinary activity of the entity. Provision for bad debt is a normal item in the ordinary course of business. Am I right? But a huge loss on account of insolvency of one of the largest customer of the company requires separate disclosure as an exceptional item. Right? Understood? So what could be the other example of exceptional item? Like telecom companies, you know, the telecom companies like Bharti Airtel, Vodafone Idea, they are paying 8% of license fee on their revenue to the government of India, to the Department of Telecom. In 1920, in the financial year 1920, you know, and what they are doing, so they have to pay 8% of the license fee, and they are recognizing that as a license fee expenses in their P&L as a normal expense. In FY 1920, the Supreme Court has given a judgment in the very old case, right? Given a judgment in a very old case, which is you know, which is going on between the Department of Telecom and telecom companies. And due to that judgment, Bharti Airtel was supposed to pay 35,000 crores as a license fee, as a pending license fee. And Vodafone Idea was supposed to pay 55,000 crore as a pending license fee, right? So friends, in this case, although paying a license fee is in the ordinary course of the entity. But when you look at the financial statement of Bharti Airtel Limited and Vodafone Idea Limited for the financial year 1920, you will find that these companies have shown this item as an exceptional item. And why exceptional item is important? Because so that user will be able to understand the yes, why the profit has been declined or profit has been substantially on the upside just because of this one-off item. So exceptional item is more of a one-off item, right? It is more of a one-off item. I hope you guys are clear on this. I hope you are clear on this. Yeah, clear? Is it clear? So friends, in case of statement of profit and loss, the concept of extraordinary item is not there, but the concept of exceptional item is there. The extraordinary item is not there, but the concept of exceptional item is there. Why? Because IFRS says that when you are running a business, of course, in your business, there could be some profit or losses due to non-ordinary activities as well, right? And you have to be prepared and you have to recognize those income and expense as a normal item, not as an extraordinary item, okay? And in IFRS, in the global concepts, in the concept of extraordinary was not there. Hence, we have also not inculcated the concept of extraordinary item in our Ind AS, right? But yes, exceptional has to be there. Why? Because it is important to understand that what is the exceptional thing which has been happened in the current year, in a particular year or in a particular period. So guys, in Ind AS or IFRS P&L, the concept of extraordinary is not there. The concept of prior period item is not there. Although this concept was specifically there in the accounting standard P&L, right? So friends, let me see if you have any query so far. Then we will move to the next part. Mr. Vikas Jha is asking, sir, as per Ind AS 1, how we will differentiate between core activities and allied in case of revenue recognition. So, Mr. Vikas, first of all, what is your ordinary activity? I mean to say, what is your core activity and what is your non-ordinary activity or what is your allied activity? It will depend upon your nature of business, right? If I talk about the companies, in the company's memorandum and article of association, you will write that what will be your main activity or what will be your key activity, right? So Ind AS 1 does not prescribe what is your core activity and what is your allied activity, right? You have to see what is the nature of business. For example, a company like Ultratech Cements. So this company is manufacturing the cements, right? So manufacturing and selling or supply of cement is a core activity. They have some sulfur or they have some, white powder as well. And they're selling the scrap, white powder scrap, right, to the other dealers, right? The residual scrap, which is one of the allied activity to the core activity, which is also known as the other operating revenue. Right. So the companies have a concept of main revenue from operations and other operating revenue. So you have to see from the perspective of the nature of the business, how management will see their important business activity, what are the line of activities. It is not no rule has been given in Ind AS 1. Second question, how will we get the gross profit since it is based on the nature-based method? So Vikas, if you see the format which is given under division 2 to the profit and loss, right? A division 2 to the schedule 3 profit and loss format, you will find that the gross profit format has not been given. The entire revenue is there. Your cost of goods sold is there. I mean to say cost of consumption is there, right? Then other expenses is there. So the concept of gross profit evolved in case of a manufacturing company, or it may be a trading company, right? For MIS purposes, if you have to calculate the gross profit, of course, you have to take what is your sales, which is your revenue, what is your cost of goods sold, which is your inventory cost, right? Your closing inventory and opening inventory, and your direct operating expenses. So you have to consider that as per the formula given in the costing. you have to take those items for calculating the gross profit. But as far as regulatory P&L is concerned, as far as division 2 to schedule 3 is concerned, as far as Ind AS 1 is concerned, in the presentation the gross profit will not be calculated. In the presentation, total revenue will be there, total cost will be there, then profit before tax will be there, the tax will be there, and profit after tax will be there, right? There is a concept of EBITDA as well, profit before interest, tax, depreciation, and amortization, right? But since this gross profit is not required to be shown on the face of the P&L. Clear? Manav is showing why can't we show huge loss on account of insolvency in extraordinary. Manav, again I am saying, having a loss in the business on account of bad debt, on account of bad debt of the customer, it is in the ordinary course of the entity. It is not a non-ordinary. Extraordinary means not in the ordinary course of business, right? Since you are doing a business, you are selling goods on credit, and hence there may be an exposure. Okay, so providing a bad debt on your collection or on your debtors, it is a in the ordinary course of the entity, right? Having a huge exchange differences, right? So having an exchange differences, if you are working in a geography which is a multi-currency geography, of course, there could be an exposure on account of exchange fluctuation. So it is in the ordinary course of the entity. But if there are huge exchange fluctuation, you have to consider it as an exchange, as an exceptional item, right? I hope it is clear, Manav. So friends, the first part is pretty clear. And we are also aware that we have to show, removal of option we have discussed. So we have to show the expenses on the basis of nature of expense method. Nature of expense method. We have to show the expense on the basis of the nature of expense method in the P&L. Nature of expense method in the P&L. Okay. Is it clear? In IFRS, the nature and function both are allowed. So part 1 is clear to everyone. Part 1 is just same kind of P&L format, which we are already aware of in our old IGAP. Only thing is, extraordinary item is prohibited under Ind AS and IFRS, and prior period item is prohibited under Ind AS and IFRS. Right? Clear? So students, it's 8:27 now. Now we will have a 10 minutes break, and we will start at 8:37. Okay. I hope my voice is audible and the Excel file is also visible, friends. Rahul is asking, sir, if we have foreign exchange difference income in the last year and foreign exchange difference expense this year, for comparative, how the same will be disclosed in the financial statement because they are shown in other income and other expenses respectively. What is a better way to present? So Rahul, in the year when it is an income, it has to be disclosed in the income. In the current year, if it is an expense, it has to be disclosed as an expense. Okay. So you cannot take, as a, for example, in the current year, it is an expense. You cannot show it as a negative line item in the expense side. Okay. You have to show it as an income in the last year. I hope it is clear. Yeah. So part one is clear to everyone. Now let's discuss the concept of other comprehensive income. So guys, in the part one, there is a profit after tax, PBT minus tax, which is a profit after tax. Then there is a part two, which is other comprehensive income. What is that part two? And what is the concept of other comprehensive income? Although other comprehensive is more of a rule-based guidance. But sir, what is other comprehensive income? So guys, few years earlier, there was a concept of profit and loss appropriation account, right? There was a concept of P&L appropriation account. And in P&L appropriation account, we appropriate something from the profit. I would say this is kind of that account. This is I'm not saying this is that account. This is kind of that account. And other comprehensive income is nothing itself. It's like a reserve account. It's like a reserve account. Okay. Friends, profit after tax is normal profit which is going to be distributed, and earning per share is also required to be calculated on the profit after tax. Coming to the other comprehensive income, generally with my experience of teaching and my experience of industry, I would say other comprehensive income is kind of a reserve item. It is kind of a reserve, right? Where you are required to show the items which are notional in nature, item which are in the non-cash in nature. Generally, other comprehensive income includes item which is reserve in nature, which is notional in nature, and which is non-cash in nature. Generally, I have used the word generally. Now, what is this other comprehensive income? So, specific item of other comprehensive income is given in the respective standards, right? And in India, one, a list of other comprehensive income item has been given, a list of, right? So other comprehensive income comprises item of income and expense, including reclassification adjustment that are not recognized in profit or loss as required or permitted by other Indian accounting standards. Other comprehensive income comprises item of income and expenses, including reclassification adjustment that are not recognized in profit or loss, Which profit or loss? Part one of the profit or loss. So other comprehensive income comprises of those income and expense which are not recognized in P&L. Which P&L? Part one of the P&L. Part one means till the profit after tax. Which are not recognized in P&L as required or permitted by other Ind AS. Who stops? Some Ind AS, other Ind AS stops, or some Ind AS required that this is not required to be recorded in P&L. It has to be recorded as other comprehensive income, which is an extended version of P&L. When it is saying that are not recognized in P&L, it means part one of the P&L, right? That has to be recognized as other comprehensive income, which is an extended section of the P&L, right? So where it has been written in some specific standard. The specific line item of OCI has been given. Sir, from where and why the concept of OCI have been evolved? So let me tell you why. Coming to the definition of income and expense. What is the definition of income? What is the definition of income? Or what is the definition of expense? The definition of income and expense is increase or decrease in net assets. Increase or decrease in net assets. What do you mean by net assets? Assets minus liabilities. Increase or decrease in net assets due to a transaction occurred with a party other than the shareholder. So friends, net assets means assets minus liability. Now tell me the payment of dividend. Dividend has been paid. Tell me, by paying a dividend, whether net assets will increase or decrease. By paying a dividend, whether net assets will increase or decrease. Tell me, by paying a dividend, whether net assets will increase or decrease. Christy, I will explain that. Don't worry. First of all, I am explaining what is OCI. Okay. So guys, by paying a dividend, whether net assets will increase or decrease, you will pay dividend from retained earnings. Your retained earnings will go down. Your net assets will go down. Your reserves will go down. Okay. Your net assets will decrease. Whether this transaction is with the shareholder or other than the shareholder, this transaction is with the shareholder. The dividend will be given to the shareholder. Right? The dividend will be given to the shareholder. Whether it is meeting the definition of income or expense, answer is no, not meeting the definition income or expense, right? Not meeting the definition of income or expense. Why? What is the definition? Increase or decrease in net assets due to a transaction occurred with the party other than the shareholder, but this transaction is with the shareholder. Right issue. By right issue, whether the net assets will increase or decrease. By right issue, whether the net assets will increase or decrease. Your net assets will increase. But whether this transaction is with the shareholder or other than the shareholder, the right issue will be with the shareholder. It is not meeting the definition of income or expense. Right? So, the buyback of shares, right issue of shares, payment of dividend, this will go directly to the retained earnings in the statement of changes in equity, in the reserves and surplus. Revaluation surplus on fixed assets, as per Ind AS 16, property, plant and equipment. Revaluation surplus on fixed assets. If there is a revaluation surplus on the fixed assets, whether net assets will increase or decrease? Net assets will increase. Whether this transaction is with the shareholder, we have restated our fixed assets at fair value, right? We have restated our fixed assets at fair value. So net assets will increase, of course. But whether this transaction is with the shareholder, answer is no, not with the shareholder. Not with the shareholder. Okay. So guys, income and expenses increase or decrease in net assets due to a transaction happening with a party other than the shareholder. So this transaction is other than the shareholder. This is meeting the definition of income. Yes. So guys, whether do you think that we need to record this definition, record this revaluation surplus as an income in the P&L? Do we need to record that? Do we need to record that in the part 1 of the P&L? Should we record here as another income? Answer is no. This revaluation reserve, this revaluation surplus is kind of a reserve. And if we will include this revaluation surplus as a other income, then probably dividend will be distributed in the revaluation surplus as well. Probably if the company has to give more dividend to its promoter or shareholder, the company will revalue its fixed assets, increase the value, right? And put it into the part 1 of the P&L and distribute the dividend. So that is why Ind AS 16 property, plant and equipment says that if there is a revaluation surplus, it has to go to other comprehensive income. Other comprehensive income is nothing. It's like a dustbin category. It's like a reserve category, right? And that is why earnings per share is required to be calculated only on the profit after tax, not on the total comprehensive income, not on the other comprehensive income. It has to be on the profit after tax, right? The dividend cannot be distributed on such notional reserves. Understood? Understood, guys? Understood? So as definition said that Other comprehensive income comprise item of income and expense that are recognized in profit or loss, that are not recognized in profit loss as required or permitted by other Ind AS. Ind AS 16 says that if there is a revaluation surplus, it will go to other comprehensive income. Foreign currency translation reserve. The company has some subsidiaries outside India. So there is a change in exchange fluctuation. So there is a change in exchange there are exchange fluctuation, and there is a change in the exchange value of currencies, right? So friends, by way of foreign currency translation reserve, it could be upside, it could be downside, right? So for example, there is a favorable FCTR, there is an increase in FCTR. So whether net assets will increase or decrease? Increase. I am assuming that FCTR has gone up, right? So whether this transaction is with the shareholder or other than shareholder, not with the shareholder, right? Whether it is meeting the definition of income or expense, yes, it is meeting the definition of income. So Ind AS 21 says that. Ind AS 21 says that. Like in this case, Ind AS 16 says that property, plant and equipment. Here in this case, Ind AS 21 says that this item has to be shown in the other comprehensive income, and the other comprehensive income item has to be shown separately in the statement of changes in equity, and your profit after tax will go to the your profit after tax 450. This 450 will go to the retained earning in the statement of changes in equity. It will go to the retained earning. This 450 will go to the retained earning. But other comprehensive income item has to be shown separately in the statement of changes in equity, in the other equity, which is nothing, which is reserves and surplus. Guys, I hope so far things are clear to you. So far things have clear to you why this other comprehensive income have come into the picture. Is it clear to you? Is it clear to you or no? I will explain more. But so far, is it clear? At one of the P&L, which is up to profit after tax, then other comprehensive income, the total of profit after tax plus other comprehensive income will be your total comprehensive income. Earning per share has to be calculated on profit after tax, not on the total comprehensive income, right? Other comprehensive income is like a reserve category. It's like a reserve. Those items which is in the nature of reserve, right? But of course, meeting the definition of income and expense will come here, right? Sir, do we need to evaluate every time? The specific list has been given in Ind AS 1 as per respective Indian accounting standard, right? The list have been compiled in Ind AS 1, okay? And of course, this list have been compiled in relation to the guidance given by other Indian accounting standard. For example, Ind AS 16 talks about revaluation surplus to be taken to OCI. Ind AS 21 talks about foreign currency translation reserve to be taken to OCI, right? Thank you, Vikas. Thank you. Okay. Is it clear, guys? Now, let's move to the next part. Sir, in other comprehensive income, there are two categories. Item that will be subsequently reclassified to P&L, item that will not be subsequently reclassified to P&L. Sir, what are those items? What is meant by these headings? So friends, in Indian accounting standard and before Indian accounting standard in IFRS, so since it is kind of a reserve item, right? So they have classified this reserve into two categories. One, the item which will be subsequently reclassified to P&L, right? And item which will not subsequently to reclassify to P&L. So subsequently means what? Subsequently means at the time of disposal. At the time of disposal. For example, on 31st March 2021, for example, on 31st March 2021, as at 31st March 2021, the fixed assets, sorry, fixed assets was having a carrying value of 100 rupees. It was revalued to 150, right? So what is the revaluation surplus? Revaluation surplus will be 50 rupees. Will be 50 rupees. Okay. So this revaluation surplus will be shown under OCI, other comprehensive income, in the year 2021, right? In the next year, and this has to be, this revaluation surplus will go to statement of changes in equity as a separate line item. For example, in this case, I have also shown this revaluation surplus. For example, it is 200. Let's take this example as a 200. Okay. This will come as a 200. Okay. It is 100 and it is 300. Revalue to 300. Right. So this revaluation surplus has to be shown in the current year as a revaluation surplus. And the deferred tax impact is also going to be taken here. Ind AS 1 says that on the item taken into other comprehensive income, there will be a tax impact also. Since it is a notional item, so there will be a deferred tax impact as per Ind AS 12. So that tax impact on these items is required to be presented in other comprehensive income only, right? So friends, subsequently Ind AS 16 says that whatever revaluation surplus is there, which you have charged to other comprehensive income, which you have taken to other comprehensive income, next year, at the time of disposal, I mean to say, this fixed asset sold out, right, next year. So in this case, friends, since it was reflecting, this 200 was reflecting on 31st March 2021 as a revaluation surplus in the statement of changes in equity. As a revaluation surplus in the statement of changes in equity, net of deferred tax, right? So what we are required to do in the next year, this OCI will not subsequently reclassify to P&L. This OCI will directly go to retained earning. What will the accounting entry? Revaluation surplus, OCI account debit to retained earnings. And who says this? Ind AS 16 says this. Right? So friends, hence, this item of revaluation surplus has to be shown as an item that will not be subsequently reclassified to P&L. So friends, there are 8-9 items which is given as a OCI item. You have to learn those items, right? As per the respective Ind AS, there are 8-9 items, and some items will be reclassified to P&L, some item will not be reclassified to P&L. Okay. So revaluation surplus is item which will not be reclassified to P&L. If the company has a foreign currency translation reserve and the subsidiary has been sold out, or the item on which the foreign currency translation reserve have been created, that item has been disposed of, sold out, okay, or derecognized. In this case, whatever closing balance of OCI will be there with respect to FCTR, that will go to the part 1 of the P&L, that will be routed to the P&L. Okay. Foreign currency translation reserve, if there is any FCTR, it will go to other income the subsequent year at the time of disposal. Okay. So this is known as item that will be subsequently reclassified to P&L at the time of derecognition or disposal. I hope the meaning of reclassification is clear to all of you. Item that will be subsequently reclassified to P&L, item that will not be subsequently reclassified to P&L. I hope it is clear to all of you guys. Yeah. Is it clear? Let me show you what are the items which is there in OCI, just as a part of just protocol. So this is your statement of profit and loss. I have already shown you total income, expenses, PBT, profit loss before exceptional item and tax, profit and loss before tax operation and tax. This is profit for the year. Okay. Then your other comprehensive income is there. You can see, let me show you the next thing. Item of other comprehensive income. Other comprehensive income to be reclassified to P&L, right, in subsequent period. Reclassified to P&L in subsequent periods. Like gain on hedge of a net investment and its income tax effect. Exchange difference, FCTR. Net movement on cash flow hedges. Fair value through OCI on debt securities. So these are the item which is given in the standard and Ind AS 1. Right. Remeasurement gains or losses, actuarial gains and losses on defined benefit plan, revaluation surplus of land and building, right? Net loss or gain through fair value through OCI of equity securities. So you will be able to understand these terms when you will read the other standards. Okay. So this is the format of your other comprehensive income. And the related tax impact is also going to be shown in the other comprehensive income. I hope it is clear to everyone. Let me know if there is any challenge. Let me know. Let me know if there is any challenge so far. Yeah, clear? Sir, do we need to, apart from this P&L which you have shown, if we want to show some separate line item or heading, can we show some separate line item or heading in the P&L? Yes, we can show, right? We can show the separate line item or different line item or heading as well. An entity shall present additional line item, headings, and subtotals in the statement of profit and loss when such presentation is relevant to an understanding of the relevant to an understanding entity's financial performance. For example, if you see division 2 to schedule 3, or if you will see division 2 to schedule 3, or if you will see Ind AS 1, you will not find. Let me show, first of all, let me show you the annual report. I hope the annual report is visible. If you see this annual report, Bharti Infratel Limited, income minus expenses, then a separate line item has been given, a separate heading has been given, profit before depreciation and amortization, finance cost, finance income, charity and donation, and tax. You will not find this line item in Ind AS 1 or in division 2 to schedule 3. But Ind AS 1 says that an entity can provide additional line item, additional subtotals or headings if it provides more clarity and it provides more clarification on the financial performance of the company, right? So the company has given EBITDA, then company has given depreciation, finance cost, finance income, charity and donation, then company has given profit before tax. So this line item is given in the Ind AS 1 as well as schedule 3, then income tax expense, then profit for the year. So company may provide additional subheadings, subtotals, line item if it is material or provides more clarity and the entity is following this presentation on a consistent basis, right? Is it clear? Thank you, Ashan. Guys, whether everything is clear or you guys have some doubt in your mind, please ask those doubts. Please ask those doubts. Everything is clear or you have some doubt in your mind? Yeah. Clear? Okay. So let me again go back to my presentation. We have discussed the concept of profit and loss and other comprehensive income, part 1, part 2. Please remember part 1, part 2 just for the reference. The total of the profit or loss is defined as the total of income less expense excluding the component of OCI. OCI is defined as item of income and expense which are not recognized in P&L as required or permitted by other Ind AS. What is total comprehensive income? It is total of PAT plus OCI. So expenses has to be analyzed on the basis of nature only, and on the basis of function it is not allowed. Minimum line item on the face of the P&L: revenue, finance cost, impairment losses, share of profit or loss in JV and associates, tax expenses, sum of profit or loss on discontinued operations. No extraordinary item, no prior period item. Okay, period items. Your company has a revenue of 100 crores, net profit of rupees 15 crores, and finance cost of rupees 1,45,000. Would you present the finance cost as a separate line item or merge it with the other cost? As per Ind AS 1 and as per division 2 to schedule 3, it has to be required to be presented separately. So you have to present separately. Okay. Would your answer be different if the finance costs were appearing for the first time? Answer is no. In the comparative, it has to be shown as a nil. In the current year, it has to be presented. Okay. These are the component of OCI which is given. It is given into your study material as well as in my notes. Okay. So you have to just remember, you have to learn that what are these items. Okay. Revaluation surplus, actuarial gains and losses with the respective standards, right? So this is your Ind AS 28. So when you will read the respective standard, you will be able to understand the treatment also. Coming to the next part, statement of changes in equity. Statement of changes in equity. What is meant by statement of changes in equity? Statement of changes in equity, it's a reserve reconciliation and capital reconciliation. It's a movement. It's a movement in equity and movement in other equity, right? Equity, share capital and other equity. Okay. So it is a separate component of financial statement. Why? It has to be signed by the, whom? Auditor as well as board of directors. Auditor as well as board of directors. Okay. So on the face for each component of equity, a reconciliation between carrying amount as at beginning and end of the period is required. What is my profit or loss for the period? What is my OCI? If there is any effect of retrospective application or restatement, that is also required to be separately disclosed. For example, due to some error, your retained earning have been changed. So this has to be shown as by way of a separate line item. Also in the statement or in the notes to accounts, the capital transaction with owner has to be separately disclosed. Movement in accumulated profit, movement in capital and reserves has to be separately disclosed. Okay. So let me show you the format of statement of changes in equity with the help of this annual report. First one is whether the format is given in the division to schedule 3. Yes, the format is given in schedule 3 as well. And Ind AS 1 also says that in Ind AS 1 format is not given, but the content is given, which says that the reconciliation or movement in equity share capital and other equity is required to be given, right? So in this case, there is no change in the share capital, and that is why addition and deletion is not there. But the equity share capital, number of shares have been given and the amount in million has been given. Okay. If you see other equity, security premium, ESOP reserve, general reserve, capital redemption reserve, retained earning, other comprehensive income, then there is a total equity. Okay. If you see this other equity format, you will find that it's nothing. It's a reconciliation has been given, movement have been given. That what is my opening and closing amount movement. Okay. So this we were also doing in notes to accounts in our old IGAAP financial statement, right? So this is my equity statement of changes in equity statement. Why it is called as why it is called as a separate component? Because like balance sheet and P&L and cash flow, it has to be signed by the auditor and board and management, right? I hope it is clear to all of you. Statement of changes in equity, right? Guys, we are not supposed to, in Ind AS 1, I'm not supposed to prepare the financial statement. The title is presentation of financial statement. I am supposed to tell you what is the presentation of the financial statement, right? So you can see, or you can look at the annual report of one of the good companies like Bharti Airtel, like Infosys, Hindustan Unilever, very good annual report. You can refer those annual report to understand the practical aspect of it as well, right? I hope it is clear to everyone. So Manini, which example you want to ask? Please explain the last example. So statement of changes in equity gives you a broader performance indicator. How my reserve is performing, right? Whether it is declining or it is increasing, right? Total recognized gains and losses or other comprehensive income, right? So retained earning has to be shown separately. OCI has to be shown separately. Okay. Cash flow statement. Your cash flow statement presentation has not given in division 2 to schedule 3. It is not given. It is not given in Ind AS 1 as well. It is not given in Ind AS 1 as well. It is given in Ind AS 7. So Ind AS 1 say that you have to prepare cash flow statement in accordance with Indian Accounting Standards 7. Right? Clear? So direct method, indirect method. So I'll take a class on Ind AS 7, and there I'll take you through with the direct method, indirect method, operating activity, investing activity, financing activity, cash, changes in cash and cash equivalent, right? I'll take you through with that. Is it clear, guys? So I have covered your balance sheet, your statement of profit and loss, including other comprehensive income, statement of changes in equity, statement of cash flows. So now I am moving to the last component, which is notes to accounts, right? So let me know if you have any query so far, then I'll move into the next part. Let me know if you have any query so far. I will quickly take that query and then I'll move to the next part. Okay. So Radhika is saying everything is clear, sir. Thank you, Rohan. Thank you for the feedback. Okay, guys, let's move on. Structure and content, notes to the financial statement. The note cell present information about the basis of preparation of the financial statement and the specific accounting policies. So, guys, it says that. So, who says that? Ind AS 1 says that. So, it is not given in Ind AS. It is not given in Schedule 3. It is given in Ind AS 1 that you have to present information about the basis of preparation of the financial statement and the specific accounting policies. Okay. So you have to give that. Understood? Is it clear? Is it clear, friends? Just a minute. Yeah. So basis of preparation and you have to give a basis of preparation, okay, and specific accounting policies significant accounting policies, okay, clear. Disclose the information required by Ind AS that is not presented elsewhere in the financial statement. Guys, what are those information which is required by specific Indian accounting standard and which is not presented elsewhere? I mean to say, which is not presented in balance sheet, not presented in P&L, not presented in SOC, not presented in cash flow. What could be those information? What could be those information, guys? What could be those information? Those information could be, for example, related party disclosure, related party transactions disclosure, actuarial disclosure, segment information, your contingent liability disclosure. So these kind of disclosures are required by the specific Indian accounting standard, and these disclosures have not been presented in balance sheet, P&L, SOC, and notes and cash flow statement. So Ind AS 1 says that you have to disclose the information which is required by the specific Ind AS. It is not presented elsewhere in the financial statement, and provide information that is not presented elsewhere in the financial statement but is relevant to an understanding of any of them. For example, in your balance sheet, a single line item has been given as a PPE. If you see the balance sheet, in your balance sheet, only a single line item has been given, right? And what is that single line item? PPE, property, plant and equipment. Property, plant and equipment, okay? If you see the balance sheet of this company, the PPE value is 5,053 crores. This is the net block. But for a user of the financial statement, I need to understand what are the additions during the year? What are the deletions during the year? Is there any revaluation during the year? What is the depreciation during the year? Right? I need to understand what is the value of the gross block. What is the value of the net block? I need to understand all these things. So that is why these things have been given in the notes to accounts. These things have been given to the notes to accounts. So in the notes to accounts, this company has given a breakup of property, plant and equipment. The breakup of property, plant and equipment. You can see that I have given the breakup of property, plant and equipment, right? I hope my screen is visible, guys. Yeah, you can see that they have given the class of assets. They have given the class of the asset, right? Then what is the value? They have given the intangible asset, the class of asset, and they have also given the gross block, the accumulated depreciation, right? And the net block they have given, right? What is the addition? What is the deletion? What is the depreciation charge for the year? What is the adjustment? So they have given all these information. They have also given the additional information, right? They have also given the additional information in the notes to accounts. Clear? Is it clear, friends? Is it clear? I have shown you the practical example from annual report as well, so that you will have a comfort. Yeah, is it clear? Okay. And it also says that notes shall be presented in a systematic manner and cross-reference in the following order. What is the order? First, statement of compliance with Ind AS. Which statement of compliance? Explicit and unreserved statement of compliance has to be given in the notes to accounts. Then summary of significant accounting policies needs to be applied. Then supporting information for item presented in financial statement in the order in which each statement and each line item is presented. For balance sheet, you have to give that note referencing 5, 6 in a sequential order, right? So supporting information means the breakup of the item given in the balance sheet and P&L. And other disclosure like contingent liability, capital commitment, right? Related party disclosure, segment information, actuarial disclosure, right? So you have to give these sort of disclosure in your notes to accounts, okay? Clear? Is it clear? So apart from accounting policy, management has to give critical judgments and estimates as well. Management has to give critical judgments and estimates as well. So let me show you with the help of the real life example. So friends, accounting policies have been given. What are the accounting policies? Accounting policies are the rules and principles. Okay. So the accounting policies have been given here. And for example, friends, your property, plant and equipment. So property, plant and equipment has to be depreciated over the useful life. What is this? This is an accounting policy. But the useful life, what is the useful life? Useful life is an accounting estimate. Useful life is an accounting estimate. Okay. So friends, in our old IGAP, we are only required to provide the disclosure of accounting policy. We are not required to provide the judgment and estimates applied in formulation of accounting policies. But in Ind AS 1, Ind AS 1 says that if there are critical judgments and estimates which has been applied in drafting or finalizing an accounting policy, it is also required to be disclosed in addition to the significant accounting policies. For example, property plant, useful life of property plant and equipment, it is required to be disclosed. Although in IGAP, the companies were also disclosing. Why? Because this is one of the disclosure requirement in PPE standard as well. Okay. But as far as a basic fundamental standard around the financial statement, Ind AS 1 says that you have to provide the judgment and estimates relating to the critical item in the financial statement. For example, leases. So this company, Bharti Infratel Limited, is a lease company, which provides hours on a lease basis. So guys, if I'm talking about a lease, management has to apply a judgment for calculating the non-cancelable lease term. Why? Because you have to do the lease accounting over a period of non-cancelable lease term, right? So while calculating the non-cancelable lease term, management has to take in consideration a lot of judgment, whether only primary period needs to be covered or the secondary period is also required to be covered, whether it is an operating lease or is it a finance lease, right? Or friend, in IFRS and Ind AS, you have to recognize a right of use asset and a leasehold obligation and a leasehold obligation for all the leases in the balance sheet, for all the leases in the company, right? So friends, for calculating a right of use asset, you have to estimate the future cash flows. You have to estimate the discount rate. So recognizing a right of use asset, recognizing an expenses over the lease term is an accounting policy. But what will be my non-cancelable lease term? Whether it will be a operating lease or a finance lease, this is something where judgment needs to be applied, right? What will be my estimated cash flows? What will be my discount rate? This is something where estimate needs to be applied. So friends, moral of the story is, apart from the accounting policies, in IFRS and Ind AS, judgment and estimate is also required to be disclosed in the notes to accounts. Let me show you. If you see in this company, significant accounting judgments, estimate and assumptions, this is given, right? Understood? The judgment has been given. As a company, as a lessor, company as a lessee, what judgment the company has applied. Okay. The estimates is also given, right? Impairment, property plant, refer note number 3A, the estimated useful life of PPE. Okay. Allowance of doubtful trade receivable, asset retirement obligation, right? Share-based payment, that how the fair value have been derived. So friends, the judgments and estimates also needs to be applied while drafting the accounting policy. I hope it is clear to everyone. Yeah. Is it clear? Is it clear? Yes or no? The company is also required to disclose the risk and uncertainty relating to the item in the financial statement, right? Let me show you the risk and uncertainty relating to the item in the financial statement. Let me show you. This is a requirement of Ind AS 107 as well as Ind AS 1. Why I am showing you the practical aspect of it, so that you will have a more comfort. Yes, it will help you while auditing the financial statement and drafting the financial statement as well. Friends, if you see, there is one disclosure, financial risk management objective and policy. What is this disclosure? In this disclosure, the company has given what kind of risk which is applicable or which is exposed to this company. For example, market risk, interest rate risk, right? In market risk, there is an interest rate risk. What is interest rate risk? This company has invested in a government securities and some bonds which will carry a rate of interest. Okay. If there will be an increase or decrease in interest rate, there will be a risk. There will be a risk of declining market price of the instrument. Okay. Foreign currency risk. The company has some exposure in foreign currencies. The company is selling. The company is importing. The company is doing some imports, right? So if dollar will be more on a higher basis, dollar will be more stronger. In that case, the company will have an exposure of losses in terms of foreign currency. Price risk. The company has invested in mutual fund. The company is invested in other securities as well. So there is a price risk which is inherent to the company. So the company has to disclose what kind of risk is there, on which item that risk is there, and what is the quantum, right? For example, credit risk. The company has a trade receivable of 861 crores, right? So the company has a credit risk from those customers, right? Liquidity risk. The company has a liquidity risk to repay the bank OD, short-term loans, lease liability, trade payable, and other financial liabilities. And as far as liquidity risk is concerned, the company has also given the maturity profile of those risks, of those items, right? The company is also given how the company is managing the capital, right? So whether the shareholder value is going to be maximized, right? What is the gearing ratio? What is the debt equity ratio? What is my debt? What is my capital, right? These kind of disclosure is also required to be given in the notes to accounts, right? Understood, guys? Guys, have you understood this thing? Have you understood this thing or not? Yeah. So critical management judgments, critical estimates, and capital management policies needs to be given in the notes to account. I hope it is clear to all of you, friends. I hope it is clear to all of you. So before moving into the differences and MCQs, let me see if there is any query. Manini is asking, sir, OCI example item will not be reclassified to P&L. Manini, so there is an example of revaluation surplus, right? Revaluation surplus as per Ind AS 16 is an example where it will not be reclassified to P&L upon disposal. If it will not be reclassified to P&L upon disposal, where it will go? It will go to directly to the balance sheet. In which item of the balance sheet? It is retained earnings. Guys, at the time of disposal, there will be two routes. One is your P&L route, another one is your balance sheet route. What is your P&L route? P&L route means whenever you are disposing of or you are de-recognizing any item in the financial statement, you have to route it through P&L or you have to route it through balance sheet. When I'm saying balance sheet, I mean to say you have to directly take it to the retained earnings. So friends, in this example, for example, carrying value of a fixed asset was 100 rupees on 31st March 21. It was revalued to 300 rupees. And what was the accounting entry? The accounting entry was fixed asset account debit to revaluation surplus OCI. Credit, okay. So this revaluation surplus was 200. Next year, this fixed asset was sold out. So the item has been disposed of. So Ind AS 16 says that it will not be reclassified to P&L. So where it will go? It will go to revaluation surplus. OCI will be debited and the retained earning will be credited as per Ind AS 16. Retained earning will be credited. So this is a direct balance sheet to balance sheet settlement. So whatever number was there in OCI, it will go to retained earning. So in this case, friends, if you see, this is a statement of changes in equity format. So whatever is there, this 140 net of tax is there. It will go to retained earning directly. It will go to retained earning. It will move to retained earning. In the retained earning, there will be a separate line item. What will be the separate line item? Item reclassified from OCI, right? And in the next year, there will be a negative. In the next year, there will be a negative minus 140 in OCI part, and there will be a positive 140 in the retained earnings. Okay, and so that user will be able to understand, okay, the retained earning have been increased not by way of profit, but by way of moving it from OCI as well. I hope, Manini, it is clear to you. I hope it is clear to you, Manini. Yeah, is it clear? Yeah. So guys, I have also discussed the questions from the study material. Let me discuss some more questions from the study material, right? Otherwise, normally in this particular standard, the example and questions are very less because this is a presentation related standard. Okay. Let me open the institute study material. Yeah. Yeah, guys, is it visible? Institute study material. So friends, A Limited has prepared illustration number 16. I hope it is visible. A Limited has prepared the following draft balance sheet as on 31st March 2001. Assets, cash equivalent, non-controlling interest, share of profit for the year, dividend declared and paid by A Limited, accounts receivable, inventory at cost, inventory at fair value, investment property, PP at cost, claims against the assets, long-term debt, interest accrued on long-term debt, due in less than 12 months, share capital, retained earning, profit for the year, non-controlling interest, accumulated depreciation, provision for doubtful debt, credit payable, accrued expenses, warranty provision for 12 months from the date of sale, environmental restoration provision, and your provision for accrued leave due within 12 months, dividend payable. Prepare a consolidated balance sheet using current and non-current classification in accordance with Ind AS 1, assuming operating cycle is 12 months. So friends, first of all, cash and cash equivalent, whether it is current or non-current, cash and cash equivalent, current or non-current. So cash and cash equivalent will be go as a current. Okay, cash and cash equivalent as a current. And note number 4. So basically, I'm not going by the number. So note number 4 says that your 250 plus 70, 320. For the current year, it is 320, right? So cash and cash equivalent is your current asset. Okay. So this 250 plus 70 is your cash and cash equivalent, right? Is it clear? Non-controlling interest, share of profit for the year. Non-controlling interest. This is the share of the profit for the year. But there must be a non-controlling interest also because the share of profit will be added to the non-controlling interest. So non-controlling interest is also given 830. 830 non-controlling interest and your non-controlling interest share of profit 160. So 830 plus 160, 990. 990. This non-controlling interest will be part of your what? This will be part of your equity and liability. So here non-controlling interest has been taken as 130. Why? Because probably they are considering that this share of profit has already been included in the non-controlling interest, right? Because these are the balance sheet number. Okay. Dividend declared and paid by A Limited. This will also be adjusted into the retained earnings. Accounts receivable. This accounts receivable will be current or non-current? Trade receivable will be current or non-current? This will be current. Account receivable will come here. Trade receivable. Okay. Trade receivable. So they have just combined some items here only. So guys, inventory at cost, inventory at fair value. So inventory is an inventory, doesn't matter it is at cost or fair value. This 1500 plus 180, this inventory will go to your current asset. Inventory will go to current asset. 1680 inventory, it is a current asset. Okay. Then your property, plant and equipment at cost. PP, investment property, it is a non-current asset. PP and investment property is a non-current asset. It will go to the non-current asset. Okay. PP, investment property. Now coming to the claims. Long-term debt. 500 crores due on the 1st January each year. 1st January means If you are preparing financial statement on 31st March, 1st January comes within 9 months. So out of 3,300, 500 will be due on the 1st January every year, right? So 500 will go to the short-term debt, 2,800 will go to the long-term debt. So 2,800 is a long-term debt. 2,800 is a long-term debt, right? And 500 is a current portion of the long-term debt. 500 is the current portion of the long-term debt. Okay. Share capital will go into the share capital. Retained earnings at the beginning of the year has been given. It means profit for the year has to be added. Dividend has to be deducted, right? So share capital, retained earnings, share capital will go as a separate line item. Retained earning will go under the other equity, note number 5, other equity. Okay. So when you go to the note number 5, you can see opening retained earning plus profit during the year minus profit belongs to the non-controlling interest minus dividend paid. Okay. This is my retained earning which have been clubbed under the other equity. Okay. Then there is an item of non-controlling interest. It has to be shown separately on the face of the balance sheet. After other equity, you have to show non-controlling interest separately, right? Then there is an accumulated depreciation PPE. So PPE has been netted off with accumulated depreciation. Okay. Provision for doubtful receivable. So trade receivable has been netted off with the provision for doubtful receivable. Trade payable and accrued expenses has to be shown separately as a trade payable, right? Trade payable and trade and other payables. Okay. Warranty provision, environmental restoration provision for 12 months from the date of sale. So provision for accrued leave due within 12 months. So this will be a short-term provision. Dividend payable will be a short-term provision because dividend has to be paid within 5 days or within 30 days from the date of declaration, right? From the date of approval. So there is a statutory provision regarding dividend paid. Environmental restoration provision. Restoration expected in 2006. This balance sheet is prepared for 2001. It is a long-term provision. Warranty provision for 12 months from the date of sale. Warranty provision for 12 months from the date of sale. The sale has been happened during the year. Warranty is within 12 months. So it is a short-term provision. Warranty is short-term provision. Restoration is a long-term provision. Accrued leave is a short-term provision. Dividend payable is a short-term provision. This will come under the short-term. So this long-term provision is environmental restoration provision, and all other provision, warranty and other short-term provision is this, right? So this is your classification of current and non-current. I hope it is clear to all of you guys. Is it clear to all of you? Carve out we have discussed. Company A has taken a loan, long-term loan from company B. Your question number 3. In the month of December, there is a breach of material provision of the arrangement, as a consequence of which the loan become repayable on demand on 31st March 2002 on the balance sheet date. In the month of May, the company started negotiation with the company B for not to demand payment as a consequence of the breach. The financial statement were approved for the issue in the month of June. So it is a post-balance sheet event. In the month of July, both the companies agreed that the payment will not be demanded immediately as a consequences of breach of material provision. So guys, advise on the classification of the liability as current or non-current. If you see the series of events, there was a breach in the month of December. The loan become repayable on demand on 31st March 2002, which is a balance sheet date. It was current on the balance sheet date. In the month of May, the company started negotiation with the lender. The negotiation has not been concluded. The company has started a negotiation. The financial statement were approved in the month of July. And the company has agreed, the other party lender has agreed in the month of July. That is after approval of the financial statement. So guys, till the time of approval of the financial statement, nothing concluded. Right? Only the talks were happening, but nothing concluded. So in this case, tell me whether the liability will be current or non-current as per Ind AS. Of course, the liability will be current because nothing has been concluded till the date of board meeting. So in this case, the liability will be current. In this case, liability will be current. Okay. Is it clear? Is it clear, guys? Okay. So Srishti is asking non-controlling interest adjustment, Srishti. Although this is part of your Ind AS 110, you will understand that. But as far as presentation is concerned, so non-controlling interest is a minority interest. Okay, kind of. So in the balance sheet, your non-controlling interest is given. Your non-controlling interest is given as a separate line item, which is 830. Okay. So this is a balance sheet number. The closing balance is given for as a 830, right? And the share of profit relating to non-controlling interest has also been given. So in other equity, since we are disclosing the non-controlling interest as a separate line item, in other equity, only the reserves and surplus relating to the controlling interest has to be there. So if my total profit during the year is 1200 and the profit belongs to non-controlling interest is 160, so in the retained earnings, this 160 has to be deducted from the total profit. So you can see the calculation of retained earning in other equity, you will find that 1200 has been added as a total profit, but 160 have been deducted, which belongs to the non-controlling interest, which belongs to the non-controlling interest, right? Is it clear? Srishti, is it clear? Is it clear, guys? Question number 3 we have discussed. Yeah, let's discuss question number 5. XYZ Limited is into the manufacturing of tractor parts and mainly supplying component to the OEM, original equipment manufacturers. The company does not have any subsidiary, joint venture, or associate company. During the preparation of financial statement for the year ended 31st March 2001, the accounts department is not sure about the treatment or presentation of below mentioned matters. Accounts department approached you to advise on the following matters. There are qualifications in the audit report of the company with reference to 2 Ind AS. So guys, there are qualifications. Now tell me, if there are qualifications, will you call these financial statements as per Ind AS? Friends, if management believes that they have complied with all Ind AS and management has given the statement of compliance with respect to explicit and unreserved statement of compliance, then such financial statement will be considered as an Ind AS compliant financial statement, irrespective of the fact that the auditors have given the qualifications, right? Okay, let me show you the answer of question number 5. Yes, an entity whose financial statement comply with Ind AS shall make an explicit and unreserved statement of compliance in the notes to accounts. An entity shall not describe the financial statement are complying with Ind AS unless they comply with all the requirement of Ind AS, right? So management must have a reason to believe that they have complied with all Ind AS, right? Clear? Is it clear? Yes or no? Okay. Let's come to the next part of question number 5. Is it mandatory to add the word standalone before each of the component of the financial statement? You remember, while discussing structure and content, I have discussed that you have to provide whether it is an individual financial statement or it is a consolidated financial statement, you are required to disclose. Yes, it is mandatory to disclose the word standalone, okay, if it is a standalone financial statement. Third, the company is Indian company. The company is Indian company and preparing and presenting its financial statement in rupees. Is it necessary to write in the financial statement that the financial statement presented in rupees? Yes. Level of rounding off and currency needs to be disclosed, right? The company had sales transaction with 10 related party during the previous year. However, during the current year, there are no transactions with the 4 related parties out of the 10 related parties. Hence, company is of the view that it need not disclose sales transaction with these 4 parties in related party disclosures because these parties, there are no transaction during the current year. Wrong. At least 1 year comparative needs to be given in the financial statement. And in the comparative, if anything which is there, which is not in the current year could be nil, but the comparative number the comparative number needs to be given in the notes to accounts. So company's contention is wrong here. The company has to give the related party disclosure for all those 10 parties, okay? For all those 10 parties. Is it clear? I hope it is clear to all of you guys. Good. So Rahul, you will read the concept of NCI in Ind AS 110. Don't worry about that. So Mohammed Hassan, if any provision of Ind AS not complied, then management should not provide explicit and unreserved statement of compliance. It is wrong then. Okay. Clear? I hope my presentation is visible. Let's discuss the difference between Ind AS and Indian GAAP. So in Ind AS, the applicable guidance is Ind AS 1. In Indian GAAP, it is AS 1. The requirement of SOCI, there is a separate component of SOCI, which is in Ind AS, but the separate component is not there, but movement in share capital and reserves and surplus is required to be shown in the notes to accounts in Indian GAAP. OCI, this is a requirement in Ind AS, but this is not a requirement in IGAAP. Extraordinary item is required to be specifically disclosed or presented in IGAAP, but it is prohibited in Ind AS. A statement of compliance is not required in IGAAP. The statement of compliance is required in Ind AS. Okay. So key source of risk, uncertainty, right? Judgment is required to be given under Ind AS, but such items are not required in IGAAP. Third balance sheet, whenever there is a retrospective correction of error, retrospective change in policy, the third balance sheet, which is opening of the comparative, needs to be presented or prepared. But in accounting standard in IGAAP, the impact has to be taken in the current year only. Impact has to be calculated from the previous periods, but it has to be taken in the current year only and disclosed in the notes to accounts, right? In P&L, the word prior period item is required to be used. Okay. Friends, so I hope you have understood. The concept of this particular, the concept of this Ind AS 1. You have understood the differences of Ind AS 1 versus accounting standard 1. As far as difference between Ind AS 1 and IAS 1 is concerned, there is one carve out and one removal of option. Manav is asking, sir, point number 4 again, please. Okay, Manav. Srishti is asking, sir, in part 2 of question number 5, if company is single, let me open that question from the study material again. So yes, if even the company is a single company, no subsidiary, joint venture and associates, still it is required to be disclosed whether it is an individual financial statement or a consolidated financial statement. Point number 4 is, for example, there are 10 related parties during the previous year. For example, you are doing a related party disclosure. You are doing a disclosure in the notes to accounts, right? Related party disclosure in the notes to accounts. This is parties, related parties, okay? For example, subsidiary. This is your sale of goods. This is your FY 21-22. This is your FY 2021. Friends, there are 10 parties, 10 related parties, 10 subsidiary. Okay. A, B, C, D, E, F, G, H, I, J. Okay, 10 related parties. In the last year, there was a transaction with all the related parties. Okay. In the current year, there was a transaction. There was no transaction with A. There was transaction with related party B. There was a transaction with C. There was transaction with D. There was no transaction with E, F, and G, and there was transaction with these companies. Right. Now it's asked that the accountant is thinking that there are no transaction in case of A, E, F, and G. There are no transaction in case of A, E, F, and G. So related party disclosure is not required for A, E, F, and G. What is your view? What is your view in this case? What is your view? So friends, Ind AS 1 says that at least you have to give 1 year comparative. 1 year comparative means comparative in terms of component as well as in notes to accounts. Comparative information includes your narrative information as well as your descriptive information, your quantitative information as well as qualitative information. If the numbers were there in the last year, then it is required to be disclosed in the current year as well. Doesn't matter, in the current year it will be a zero, it will be a nil number. Okay, so this was required under Ind AS 1. Is it clear, friends? Thank you, Rahul. Thank you so much for the feedback. Srishti, everything is clear to you? Is it clear, friends? Let me know if there is any issue. Is it clear or not clear? Great. Thank you, Radhika. Thanks for the feedback. I'm glad that you liked my teaching. So I'll take a 15 seconds pause. Thank you, Srishti. I'm glad that everything is clear. So friends, since morning, we have discussed the key features of the financial statement. What are the key features of the financial statement? True and fair view in compliance with all Ind AS, right? The financial statement has to be prepared on a going concern basis. Then we discussed the concept of accrual basis. We discussed materiality and aggregation. We discussed offsetting. We discussed consistency. We discussed frequency of reporting. We discussed comparative information. Then we discussed the relevant part, structure and content in terms of balance sheet, in terms of P&L, in terms of statement of changes in equity, in terms of cash flow statement, in terms of notes to accounts. And we have also discussed the concept of third balance sheet in the last class. As far as balance sheet is concerned, we have seen that as per Ind AS 1, we are required to, we can prepare our balance sheet on the basis of current and non-current classification as well as on the basis of liquidity if it is more relevant, right? If it is more relevant. And we have seen that as far as Ind AS 1 is concerned, the format is not given in Ind AS 1, but the content is given in Ind AS 1 with respect to your balance sheet, P&L, statement of changes in equity, and the guidance relating to notes to accounts has also been given. So far, we were only aware that in our notes to accounts, significant accounting policies needs to be given. But in Ind AS and IFRS, apart from significant accounting policies, your accounting estimates and judgments is also required to be given, right? Is it clear? Vikas is asking, sir, since there is no concept of extraordinary item, will it impact ratio calculation as well? Of course, yes, Vikas, since we used to adjust these items while calculating ratio. So Vikas, there is no concept of extraordinary item. Extraordinary item has to be shown either as an exceptional item or as a normal item in the P&L, right? Thank you so much, guys. Thank you so much. I have completed Ind AS 1. So you will get all the notes and PPTs on your Board of Studies portal. I would request you to please revise the entire Ind AS 1. You have to again listen this video on YouTube and you have to revise the entire concept with the help of the Institute study material. I have taken some examples. Whatever example I have not taken, you have to solve those examples also because the answer is also given in the Institute study material. Thank you so much. Bye-bye. Take care.